Hello, everyone. Today on the final bar, we're going to wrap the week. We'll look at how things have evolved from last Friday to this Friday. S&P selling off through much of the day, but sort of a quick spike going into the close to pretty much net a flat day here on Friday. But the week has been volatile. The week has been marked by, offense taking off, defense taking off, feeling like rotation going back to normal. And we end with a rotation back to about flat. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for the show as we try to make sense of these markets together using the toolkit of the technical analysts, looking at market sentiment, investor psychology, most importantly, the trends, the momentum, what prices are doing, and what we can learn from those that flow of data. As I mentioned, the S&P in recent weeks, it's been all about this S&P 3,400 level. And I feel like, I've talked about the potential of a double top. We've reviewed some of the ideas leading up to that. We had all these bearish divergences as the S&P neared 3,400. And now having reached it, we've been unable to eclipse it. And I would say, just anecdotally, you'd assume a lot of people would be assuming some sort of top. And at the very least, there's a self-fulfilling prophecy that I would argue is probably at play here as we wait to find the catalyst that's going to push us to higher highs potentially. Now, it's not just me helping you navigate these markets over the coming weeks. We have some fantastic guests on the show. This week was a lot of fun with Ari Wald, with others this week. Next week, we have Jesse Felder on Tuesday. On Wednesday, we have Katie Stockton from Fairlead Strategies. And on Thursday, the 20th, Samantha LeDuc from LeDuc Trading. Also coming up on Monday after the weekend, we have Tony Turner on our next episode of Behind the Charts. This is going to be the last episode of Behind the Charts for a little while. It's the end of season one, if you will. We're going to retool it, gather some new interviews, and relaunch it hopefully very soon and give you some more insights into the minds and practices of some of the best strategists and traders out there. Let's get to our market recap, focusing on what's happened. I did want to start briefly with a poll here as we wrap this week. We asked you recently on StockCharts TV, on YouTube, on Twitter, where do you think the S&P 500 will close on December 30th, 2020? And I will caution you by saying, look, I think it's fun to guess where the S&P is going to be. None of us know for sure, and if you ever have the expectation that anyone on this show or elsewhere knows for sure, then that's incorrect, and that's a false sense of security. It's all educated guesses. It's all probabilities. Having said that, I think having a base case in mind can be really, really helpful. You always hear me talk about, or often hear me talk about, my base case is XYZ, and I'll tell you what that is for the S&P here momentarily if you missed it. So I asked all of you, essentially, what's your base case for stocks going through year end? 33% of you, about 1 in 3, said the S&P will close the year above 3,600. That's another 200 points above where we're at today. 31% of you said between 3,400 and 3,600, basically between where we're at and 200 points positive. 17% of you said, at where we're at now, we're 200 points below, and 18% of you said below 3,200. So couple quick observations. Number one, 64% of you, almost 2/3 of you, said we'd basically be above current levels at the end of the year, which, I can't say, there's a valid argument as to why that could certainly be the case, but it's certainly leaning more bullish than I might expect with us at the previous highs. Only 18% of you said we'd be below 3,200. 3,200 is not that far away. That's 200 points down, right? So when we talk about things like a 10-15% correction, that quickly gets us down to to levels like 3,200 that seem so far in the rear view mirror, but it very quickly can be coming closer. I didn't vote in this. If you asked me to vote, I would probably say between 3,200 and 3,400. I don't think that means we won't get above where we're at. I think we will get both above and below where we're at by the time all is said and done. The question is, what's the trajectory between now and then? I think that's the game of trend following, to be honest with you, right? Is focusing on the trajectory, focusing on the trends, and seeing what we can see. Let's get to our weekly wrap, really focusing on the evolution of the trends over time. And we'll touch on some of the movements today as just a quick recap. The S&P essentially was flat, mid caps, small caps, everything essentially sideways. And again, given the big move that we had out of the lows, bonds were weaker today, really spent the afternoon sort of lightening up. And then gold a little bit lower, silver lower as well. And that's coming off of yesterday where they had like a nice bounce off of the sell-off. You know, looking at the S&P and just thinking about the base case here, you know, again, I think the fact that we've reached 3,400 is a level a lot of people, including myself, when we were back here in April, it did not seem possible or anywhere near reasonable that we would round trip and get all the way back to 3,400. It wasn't the V bottom much after mid-April, right? That was sort of the V. After then, it was sort of a slow and steady rise with some notable pullbacks and notable corrective patterns as we go back up to that 3,400 level. But we've arrived, and the question now is, you know, what next? What do we do? Some would argue, and Ralph Acampora, when I interviewed him a couple weeks ago for charting the second half, his argument is to really propel us higher, we need to have that leadership rotation. We need to rotate away from what got us here. We're at that point where we need to have some new leadership. And I think you've seen signs of that, but not really the follow through of that. We keep coming back to this sort of default mode of the mega cap tech consumer communication services stocks going higher. And I think midweek, this is sort of what we saw here in the equity space. Others would argue it's just the path of least resistance is up. We've gotten to this point. Nothing needs to change. The same catalysts are there. The same headwinds are there. The same tailwinds are there. We could continue on and go much, much higher, at which point you load into mega cap tech, you load into biotechnology, you load into you know, those kind of groups that have gotten us to this point, and assume that outperformance of those groups will continue over the long term. Semiconductors and others will continue to go higher. You know, the third argument, I guess, or maybe an alternate hypothesis to that continued uptrend is that this is in fact a big double top. This is now the second peak within at the end of a cyclical uptrend. And what signs would we want to see to go lower? You know, I think, again, my base case, which we've talked about before, is I've highlighted the blue area on the chart of the S&P 500, and I think it is fairly reasonable whether you are long-term bullish and you voted S&P 3600, or you're long-term bearish, S&P 3200, which is, again, not that far, it's only here, or even lower, 3000, right, which would be the low from June. Either way, I think the best thing for all of us would be a pullback to around 3200 to 3250, which would mean a pause, a pullback to previous support. That would mean, you know, some validation that there's that it's not just going to go straight up. But if you're bullish, again, these extended markets where they just keep going and going, at some point you have to feel like that's gone too far, and that at some point people will talk about extreme valuations, which I've been hearing. You know, we're overextended, we've gone too far too quickly, and as a result, we need to sort of right size it. So I think that move back to there would pretty much satisfy everybody, because it would feel like a reasonable pullback. It could feel like the beginning of a downtrend, depending on what you're going to see next. But if and when that happens, I think that's going to be the key moment, right? Either the S&P finds support at a level like 3,200, or you know, it does not. And if it doesn't, and we start breaking down through the 50-day, I think you need to start, you know, thinking about more further downside. And it's less the chart of the S&P, I think, that's going to be more difficult. When I think about the you know, the S&P doing things like that, I'm looking at a chart of biotechs, and I'm thinking, well, if that's going to happen, if the S&P is going to come off, then biotechs are most likely going to keep rotating lower, which means they're probably going to break down through the June lows. And if you think about it, most things, biotechs are a little different. Most stocks sort of had a peak in early June, they kind of came back, and now they're sort of retesting, sort of appreciating. And if you see stocks breaking that swing low, that's what would most likely happen if you have the S&P rotating lower like that. I think charts like the IBB would potentially start to look a little more negative, a little less constructive than we've seen previously. So I think it's less the chart of the S&P that would concern me. It's more what that's going to do for individual stocks, and stocks that have been in good runs, like the whole work from home names, Zooms and others. Shopify, others, all of a sudden start to rotate lower and start to be testing support. They show that they won't just go up permanently. And the question is, are we at that point where we start to see those signs? Having said all of that, for me, I have two purposes when I'm looking at charts. Number one, define the trend and follow it. And I would say there's no denying the trend has been positive and remains positive. I think that's still in play, and we'll look at a chart in a moment that confirms that. Question two is always challenge that thesis and look for alternate hypotheses, look for alternate approaches, alternate scenarios, and think about what you would do in there. So what I'm thinking is, what if the S&P stops going up, and what would I look for, and what would tell me to stop fighting a pullback and consider it more of a downtrend? Let's look at the Mindful Investor Live chart list and see, start to put a little more detail behind sort of the overall approach I just described to you. Number one is the market trend. This is the weekly chart that I refer to pretty much at this point every week. It has three components. The long-term trend is based on the 21 and 34-week exponential moving averages. That turned positive here in June and has remained positive through today. The medium-term trend is defined by the weekly PPO using the traditional settings, 12 and 26, and a 9-bar smoothing. That turned positive in May, has remained positive as well. The third piece, which is more of a quick and easy short-term trend, as defined by the distance between these two moving averages, and if that is increasing in a positive way, it is a positive short-term trend. If it slows down, it's negative. We had a bit of a pullback, though, a bit of a tightening in those two, and so technically, I would define this as the short-term trend being bearish based on that slowdown. But again, we're sort of in that period. It sort of spiked up here and has remained in a pretty steady pace over that period. So that's more of a technicality than really a signal of any sort of trend reversal. We talk about the daily chart, and again, what jumps out at me looking at this chart is this bearish divergence. It looked like a divergence here with higher highs in price, lower peaks in RSI. That has changed a bit, but we have now had a much higher high, and which again arguably is not done yet. I don't know if we can declare this uptrend over yet. But at this point, we have a lower peak. It could end up materializing into more of a divergence, but that is validated by a breakdown of sorts, which we've not seen yet really with the S&P. Looking at the breadth by cap tiers, this chart is now color-coded all green based on my very subjective view of these different metrics. So here's the daily close of the S&P. So on a closing basis, as we know, we've not eclipsed that February high yet for the S&P 500. But if you look at breadth in the form of the New York Stock Exchange common stocks only, we have broken above the June high, which for me was sort of that indication that the breadth was long and strong, all clear to the upside. And we've gotten that closure, I think, this week, indicating a higher peak there. You also have a higher peak, a breakout in the advanced decline line on the S&P, on the mid-cap index, on the small-cap index. So all of those across the board are ringing bullish. I think you have a confirmation of uptrend in the form of positive breadth. Ari Wald, my guest yesterday, and I talked about that very briefly. So if you missed our conversation, may want to check that out as well. It went a lot of other places as well. But I think, for me, I asked him, what would you need to see to turn less bullish than you are? And his comment was some weakness in breadth. And again, it's hard to find a breadth reading that doesn't overall look at least supportive, if not very bullish, and at the very worst, kind of neutral. Speaking of which, in the last couple of days, you have seen a pullback in new highs on the S&P. This isn't updated for today, but I can't imagine it's going to go up from here. So overall, we've peaked out around 10% of the S&P, making new 52-week highs. That's come off, and again, that's just the last couple of days. I don't want to draw any dramatic long-term conclusions, but we talked about feeling, increasing confidence in further upside would, for me, need to see increasing numbers of stocks making new highs. That would tell you that just like the S&P trying to beat 3,400, individual stocks were trying to eclipse their highs and able to do so, and we're not seeing that yet. So until you see an improvement there, it's not negative. It's just not as bullish as it could be. In terms of what is supportive, another breadth measure, this is the percent of stocks above their 200-day. As of yesterday's close, over 61% of S&P names in that condition. As long as we remain above 50% on any pullback, I'd feel okay about the potential for further upside. If you look back over time, that tends to be what happens when you have a viable pullback within a long-term uptrend. We bottom out around 50% before it resumes higher. That's what I would look at there. You know, an interesting move here in the AAII rankings. We didn't talk about this yesterday. It comes out every Thursday, but I just wanted to make a point of pointing it out here. 2 weeks ago, it was 30% more bears than bulls. That difference has narrowed to just about 12%. So as of yesterday's vote, 30% of respondents were bullish, 42 respondents were bearish. You've had a decrease in the number of bears and increase in the number of bulls. What's interesting to me looking at this chart is that even with the fact that we have round trip from 3,400 to 2,200 and back, there are still more bears than bulls. I think individual investors, based on this subset as part of that survey, more than I've seen in a long time, are remaining overall unbelievers or in disbelief at the strength of this uptrend. In terms of some rotations, we'll get to some ratio charts here to wrap up our wrap of the week. And I want to start just looking at the ratio of consumer discretionary versus staples. Overall, favoring consumer discretionary on an equal weighted basis certainly has been that way over the last month. What's interesting here is if you look at the ratio of consumer discretionary versus technology, remains flat essentially since the March low. Even though we think of tech as being leadership, it's not like you've gotten more from being consumer discretionary on a cap-weighted basis. And one way to actually illustrate the strength of technology outside of the XOK is looking at semiconductors. That long-term trend remains positive. So again, another sort of guidepost I would use to check myself if the market pulls back is, are semiconductors starting to struggle? Because overall, they've been fantastically strong since even before the market low in March. Just to finish off, two other charts I wanted to show you. I think number one, small caps versus large. You've seen an emergence of small caps over the last month. That's after the previous month, June into early July. Out of the June market high, you saw small caps underperforming. It felt like that was going to be the beginning of something deeper. That's actually a reverse, and it's threatening the peak from that market high in the June. So that's an interesting chart to pay attention to in terms of a continued outperformance of small caps, which means as a stock picker, I'd be looking down the cap tiers a little bit. And then finally, I just want to point out, again, the S&P outperforming global stocks. That's on the dollar, stopping its trend of severe weakening, at least for now. So it's favoring U.S. stocks over non-U.S. stocks. Let's take a quick commercial break. We're going to be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is so much fun to be with you every afternoon after the close to look at the charts together and highlight some of the themes that I'm seeing in my review of the charts, and also working with a lot of fantastic experts in the industry. As a reminder, we love answering your questions. Just shoot us an email, thefinalbar@StockCharts.com. We'd love to answer one of your questions next time we do a mailbag segment. We need to start ours. Right now, though, this is the Final Bar mailbag, capturing some of your questions over the last couple days. Here we go. Great show, David. How did you plot the S&P, the Qs, the TLT, the dollar, gold, Bitcoin, all on one chart? Absolutely. And boy, I wish I could find that chart quickly. I think it's here. There we go. So there are a couple ways to do it. We have a set of charts called perf charts. And if you don't know those, what you do is at the top, switch sharp chart to a perf chart, and that's a performance chart. You can enter a series of tickers separated by commas, and you can chart them over time. That gives you a lot of flexibility about, just dragging and looking at histograms and everything. What I tend to do, though, because I like to put them into chart lists, so I like to have them as, so this is my intermarket analysis chart list. It has all of them individually, and then I can show one chart with all of them on here. Here's what you do. You run a chart of the S&P 500, and then at the bottom, a couple tips. Number one, set the type of chart to performance. It's usually up here like OHLC bars or candlesticks. Switch it to performance. What that's going to do is start the clock at the left side of the chart and give you a percent change over that time period. Then you want to add an indicator called price-performance and then enter the tickers of whatever else you want. You're limited on these charts So I think up to 10 tickers, just because after that, it starts to get a little unwieldy. And to be honest with you, the chart's not going to make a whole lot of sense after you add that many tickers anyway. So, 3 to 5 is probably the sweet spot. Even this is getting a little spaghetti-like to show all these together. But that is what I do. And then you'll see up here, there's the legend that does. A lot of times I'll add some text on the chart just to remind myself and viewers what I'm referring to here. But that's the way you do it. Use the regular Sharp Charts platform, enter the S&P or whatever you want as sort of your starting point, and then just add price dash performance, add the tickers. You can change the colors, the style of all the lines. That's a great way to compare different assets together. Next question, how did you calculate S&P 3600 as a target? Was it a height of the line equal to the lower line till the bull flag pattern? Yeah, I mentioned this. I think I mentioned it even in passing earlier. And as I was doing it, I was like, I kind of blew through that whole bull flag thing. I won't even remember what episode it was when we actually talked about it, probably back here in May as we sort of saw it. So I'll remind you very quickly what we're looking at here and then what the measurement is. So when you have a big move off of a low, an uptrend, and then you have a pullback, a corrective pattern. So you have an uptrend and then you have a shorter pattern of lower highs and lower lows. So it's sort of a counter trend move. Think of it as just wave one, and then this is like a wave two, sort of against that trend. That is what's called a flag, and it sort of looks like the flagpole, which is what you call this trend leading up to it. And then you have this little flag. It literally looks like the corrective pattern. It becomes a flag pattern. It's a qualifier, a validated flag pattern when you break above this upper trend line. So the keys to this are a parallel trend. So you have lower highs and lower lows where the slope of those is about equal. This isn't perfect, but it's close enough for me. Then once you break above the upper end, break above that resistance level, that trend line, that's what validates it, qualifies as that a flag. When it does that, the way you measure the minimum objective is basically the height of the flagpole, which is basically the distance from the low to where the pattern starts, and then you project that from the exit point. So basically you can see this purple line. I basically drew a line here to that point and then connected it to there. And I can't show you all the way above here, but basically if you do the math from that point to there and you take that distance and you add that same amount up to the top, and I'm using a log scale chart, so I'm using log scale measurements, it gives you around 3,600. You can even visually just see how long the line is and get a sense of where it's gonna be here. So it's interesting that it lines up with about 200 points above where we're at right now. At the time, that seemed nutso that we would get from 2,950 up to 3,600, but now it doesn't seem that far away to me. So that was what I was getting to. Next question, maybe a month ago or two, you interviewed a guy at a conference. I looked through YouTube and couldn't find the video. And you asked if he had only one thing to go by in the stock market, what would he use? I think he said something like the 2-year, 10-year ratio or something. I couldn't hear exactly what he said, but I remember him stating it helped investors avoid every major downturn. Really good question. I looked at this earlier and I'm guessing, and again, and I'm so sorry. I wish I remembered. Some people are really good at remembering particular details of particular interviews. I don't, and I wish I did, because I would love to say, yeah, this was the guy, this is what he said. So I'm assuming it's one of our interviews, maybe at Behind the Charts. We've interviewed a lot of people, and I love to ask people what their one chart would be. So if you had one chart, and besides the S&P, what would you use as a way to validate or give yourself an overall bias in the market? I've had some great responses over time, and it's led me to just think about some different dynamics. I'm guessing what they said was something about this. 2s versus 10s is a common measurement you use to determine the shape of the yield curve. And so if you think of the yield curve, and just as a quick aside here, I'll go, let's go here. If you go to charts and tools, there's something on here called the dynamic yield curve. And that's just a quick way to visualize what this actually looks at. So this is the short end of the yield curve down to like 3 months. That's a 3-month treasury bill, all the way down to the long bond, the 20-year and then the 30-year bond. And what happens is as you fast forward the time, you can see the change in the yield curve. That's the trail length, animate, that's what I meant to do. You can see as the S&P is going on here, starting in 2000, this is the shape of the yield curve, and it's updating it every day. So it's showing you the 3-month to the 30-year point, the short end to the long end. And you talk about the shape of the yield curve because obviously in a steep yield curve tends to be good for companies that are trying to, borrow and lend at different points, right? So if you think about what a bank's business is, it's taking in deposits and it's lending them out. And so, basically taking in deposits over time and then lending them out at a different at a different duration allows them to make money on this shape of the yield curve. It also allows companies to get financing and et cetera, outside the scope, unfortunately, of a couple minute mailbag segment. Having said that, when you have an inverted yield curve, when the when the short end is higher than the long end, that tends to be disruptive. And most recessionary periods have been preceded by an inverted yield curve. And I'm showing you this chart. This is the 2s versus 10. So basically what I'm doing is taking this point here, the 10-year point, minus the 2-year point. So if that's a positive number, it's a positive slope. It's a negative number, it's a decreasing slope. And this ratio or this difference between 10 and 2-year yields, this is represented by the black line. You can see when it goes below the 0 line, soon after you have the recessionary periods, which I've shaded in this beige pattern. So if you look here, that's like the early 90s. That is the 2000 to 2001 period. That's 2008 to 2009. Also the 1982 low, all of that. So, you know, what's happened is an inverted yield curve. When this goes below 0, which it didn't quite really do using this particular metric a year or so ago. That is one thing that people would look for because, again, most recessionary periods have been preceded by this inverted yield curve. And I think, I'm guessing what was happening is we're nearing that level where the yield curve may have been inverting, and that's what we would look for. That's all the time we have for the mailbag. Boys, sorry, I took on some meatier questions that limits how much we can do, but I tell you what, we'll continue to do this next week. And so get more of your questions to us via email, thefinalbar@stockcharts.com. We'd love to hear from you. We need to wrap the show. Go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P with the breadth by cap tiers. We talked about this earlier during our Wrap the Week segment. And just as a reminder, I overall have respected the fact that the market has gone up. And I know at times in here I've been pounding the table in some way, either intentionally or unintentionally, talk about the potential for downside. And that is how I'm wired. When things are going great, I'm always looking for signs that they aren't, because I want to anticipate and think about potential downside risk and how I would, you know, manage that, right, as an investor, as a strategist. So one of the things I would be looking at is this breadth. And I think at times it's looked like the breadth has not been confirming, you know, where the market's gone higher, but breadth has not been the case. And I think a perfect example of that was in January to February, where the S&P went to higher highs, but a lot of these breadth measures did not. They did not you know, confirm those higher highs. What's happened now, though, is that you're seeing breadth measures are all turning positive. They've all qualified or confirmed this break above the June high, suggested that overall the average stock is participating. It's in pretty good shape until you see a change in the pattern of these breadth measures. It is realistic that the S&P could continue to go higher and these breadth measures would roll over, especially in the mid cap and small cap space. I'm not seeing that yet, but that's what I would be looking for there. Chart number 2 is the AAII rankings. And again, with this survey, I think what strikes me looking at this chart right now is basically it's a similar pattern to what we saw during previous bear cycles. And you've not seen, it's an unloved bull market according to this survey. Bulls have not outnumbered bears since February, since the market top. So we're right back at that same level. And even though the S&P has returned to that same value, the optimism that we saw here in February has not returned. So what that tells me is that people are not, you know, all in mentally on the fact that the S&P's gotten to this point. It tells me that it's questionable what the upside could be from here in terms of psychologically people prepared for much further upside from here. But again, the S&P's gone from, you know, 2,200 to 3,400 on that negativity. So I have to assume it could go further. Finally, we did not get to this chart in our Wrap the Week segment. I did want to point out one of the ratios I look at is stocks versus bonds, the SPYs versus the TLT. What we saw here is an increase in this ratio, obviously with the stocks outperforming out of the March low. Since the June peak, you saw some stabilization, some consolidation. Just this week, you've seen the ratio now break to a new swing high above the peak in June. So now it's confirming stocks outperforming bonds, and that overall it's telling you to favor that side of it. And we didn't look at a chart of the TLT, but certainly struggling relative to the S&P testing all-time highs. Folks, that's our show. That's a wrap for this week on The Final Bar. I want to thank you so much for joining us. All of our previous episodes, including some fantastic guest interviews, are all on our YouTube channel. But you're always welcome to join us live on StockCharts TV. As a reminder, get your questions to us at any point. The final bar at StockCharts.com. We'll do another mailbag segment next Tuesday. Folks, for StockCharts.com in Redmond, Washington, this is Dave Keller. Have a fantastic weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.